In today's episode, we are going to be breaking down a Delaware statutory trust. We're going to be breaking down what it is, how does it correlate with 1031 exchanges, when do you do it, what are the pros, what are the cons, and most importantly, we're going to be going over how to underwrite Delaware statutory trust. To help us with that, we have Dr. Daniel Rubin. He's an investment advisor with Life Strategies Advisors. Welcome to the podcast, Dr. Rubin. How are you?
Good. It's a pleasure to be here.
Likewise. So for our viewers out there that don't know what a Delaware statutory trust or a DST, what is a Delaware statutory trust and when do people use it?
Delaware statutory trust is a construct that was put together through revenue ruling by the IRS in 2004. And what it did was for the appropriate client, it provided a way to be able to do a 1031 exchange. That is, if you have an investment property, whether it's a condo that you rent out or a house that you rent out, Airbnb or otherwise, or any commercial property, really, any property that's for investment purposes. Let's say you don't want to be a landlord anymore. You're tired of all dealing with trying to go ahead and get your rents on time, dealing with repairs and so forth. How can you do a 1031 exchange and exchange one headache to another headache? So they created a construct where they basically said that as a replacement property, if you have something structured as a Delaware statutory trust, otherwise known as a DST, and you put a property within that structure, that will be considered for the purposes of a 1031 exchange, which allows you to defer all of your capital gains taxes. It qualifies as a replacement property. The features of a DST that make it different is that you no longer have any management responsibilities. Normally, within a DST, they'll have one or more properties. They are investment properties. And they're generally institutional grade properties. So they're things like from $30 million to $100 million. And you will get your proportion of it. You are going to be a sectional owner. You are, in essence, allowed to put in your money directly from the accommodator, from the qualified intermediary. And you are able to purchase into a property that is institutionally managed and there is a trustee that ultimately will manage and make sure that the property is managed properly for the benefit of the investors.
Got it. Do you have to be an accredited investor in order to be able to invest into a DST? And if so, what is considered an accredited investor?
Yes. This is considered by the IRS, it is considered real estate, replacement real estate. Therefore, allows you to put $1031 in deferred. By the SEC and FINRA, it is considered a security. Therefore, it cannot be sold with a real estate license. It has to be sold by someone who has a federal license, which is a Series 7 or a Series 22. And so it is considered a security. And as part of a disclosure that I must go ahead and tell you about now is that this is for information purposes only. This is not a solicitation to sell any product or anything like that. So this is basically for educational purposes only. So ultimately, only accredited investors are qualified to participate in a DST investment. What is an accredited investor? In essence, it is someone that either earns, if they're married, file jointly, if they earn $300,000 a year or more, or if their total assets are $1 million or more. That would make them an accredited investor, and they would be thus qualified to participate in a DST investment.
Now, the total assets are excluding the primary residence, correct?
Excludes the primary residence, yes.
Fantastic. Okay, good. And then, how does somebody select the right DSTs to invest
Okay.
in?
The first thing, that you have to do in these before actually purchasing a DST is you have to come to someone like me who is a financial advisor who knows about real estate and who knows about financial structuring, because you have to underwrite both the real estate itself and you have to look at the financial structure. Make sure that it is adequate. There's a lot of financial structures in there and you have to kind of know what you're looking at. But the first thing is to make sure that it is a suitable and appropriate investment for the person who is considering entering into one of these agreements. The first thing that someone has to do when they come to me is I have to look, in essence, at what I have to make sure they're an accredited investment. I have to, in essence, put their balance sheet together, look at all their assets, look at their liabilities, make sure they have sufficient liquidity, because this is an illiquid investment, and to make sure that it is suitable and appropriate for them. And that's really the hard work, is once it seems like it's suitable for them and it's a good idea to do something like that, and it will be ultimately to their long-term best interests, the next step is to look at what investment they are considering selling, and to look at how much of a loan they have in there, to look basically what their cost basis, the original cost basis. Because one of the things that I always like to do is this. I want to make sure that they really have a tax liability that they're trying to offset. So some people, if ultimately they don't have a lot of a tax liability, it might be worth it for them just to sell, take the money, and then go out, look for real estate or whatever they want. But if they really are going to defer taxes, therefore, there's a real value add to doing this 1031 exchange and considering a DST. So I want to make sure that I see their tax returns, that I have an idea of what their cost basis is, and the fact that it's going to be a real value add for them, because they're going to defer some real taxes. The next step, ultimately, is once they close, we need to look at how much of a loan they have, because part of the rules of a 1031 are, if you want to defer all your taxes, you must, first of all, make sure you take no constructive receipts of any cash. So once you close and the money's in escrow, it needs to go directly to a qualified intermediary. All 1031 exchanges must go through a qualified intermediary. You cannot actually take any constructive receipts of any of your cash. That's number one. So all your equity is put in. Number two is the value of the replacement property must be equal to or greater than the value of the property that you sold. So let's say you had a property that you sold for $1 million. $500,000 was equity that you took out, but there's also a $500,000 loan. So what we do to get you into the proper DSTs is we'll find you something that has a $1 million, you're going to buy into $1 million property with $500,000 of equity that you're bringing in, but also there will be $500,000 debt. If you bought into a property that is just, you're putting in $500,000 equity and there is no debt on that property, you would owe tax on that debt boot. You must replace both your debt and your equity. And that's just a 1031 law. That's section 1031 of the Internal Revenue Code. That's true for any 1031, whether you're buying another piece of property per se that you can touch and manage yourself, or a DST. Those are the rules of the 1031. We have a lot of flexibility to get you the exact dollar amount of what you need, as opposed to going out looking for something in the market that might be a little less in price or a little more in price. So we're looking for something that will replace, if you want to defer all your equity, that replace both your equity and your debt. The nice thing about a DST that's different than if you're going to buy a piece of property is that you don't have to go out and get your own financing anymore. The financing is done for you by the DST sponsor, the people who actually bought the property and put the whole put the whole program together for you. And they already have the financing in place. Your name does not appear anywhere on that loan. It is non-recourse to you in any way. So you don't have to go through underwriting and try to go get financing, and which is an advantage to many, many, many people. Now, generally speaking, the ideal clients for something like this are people that don't want to deal with ownership anymore. So very, very often, you have people that have owned properties for a long time. They have a lot of gain in value. They would have a lot of tax liability if they have to sell. And they may be older, and their kids don't want to go ahead and manage the property. This could be an ideal solution for people like that they're done. They don't want to make their killing at real estate. Their goal, in essence, is to preserve the value of their real estate assets, to get income, and ultimately, the goal in the long run is to be able to transfer those assets to their kids income tax free until they can get the step up in basis. So for estate planning purposes, it's very smooth. You have 11 kids and you have a DST structure, rather than fighting who has the property, who manages the property, who gets what. You say, I want to divide this into 11 equal pieces. You can do that. Makes it a lot easier. And I always say it's not a good idea to pass on to your kids things that are indivisible, because if they got something to argue about, they will.
100%.
So, yeah, this helps with conflict-free estate planning,
which is very common. And I don't think that a lot of people realize that. I've had situations where the trust states that the property's to be put in all 5 of the children's individual names versus naming a trustee. And man, does that lead to a lot of
causes problems. And this is the last thing parents want. But I'm telling you, if there's something to fight about, somehow it brings out the best or the worst in people, and it creates a lot of family conflict, because obviously different people are in different situations at different times in their lives. And when you ask them to go ahead and then be partners in a particular decision, there are going to be differences of opinion. So this is one of the things that I really find a lot of value in, is that it's pretty conflict free, because you can split it any way you want.
Got it. Here's what I was going to ask you. So the loan and the equity sounds like it's very important in the DST or any 1031 exchange. Let's say that 100 investors invest in one building. Would they all have different loan to equity structures?
No.
Or will they all have the same structure? Like that investment just has 50% loan to equity, meaning anybody that has 50% would go into that investment, or how would that work?
Yes, it's the way that these DSTs are put together is you have the trustee, or otherwise known as the sponsor.
Mm-hmm.
And I think one of the most important things is to really do a lot of diligence on that sponsor. Since you, as the investor or the beneficiary of that trust, does not have any control over the management of that trust, then you have to really know who it is that does have control. And they are restricted within the rules, within the construct of the IRS revenue ruling, which is built somehow to protect investors. They're the ones that ultimately are making the management decisions. So you really need to understand who that sponsor is. Now, there are many ways to do it, but the way that I do it, I make sure that the sponsors, first and foremost, are either very large, multi-billion-dollar real estate companies. They buy the property or properties, and then they package them into this structure and offer it to investors. Now, what does that do? First of all, it tells you they're very well capitalized. They've already purchased the property. Then they go ahead and do the legal work by putting into the proper legal framework to be able to offer it. to investors wanting to do a 1031 exchange. And they will ultimately get a loan. They'll get the loan. And they're usually able to get much better loans than you or I can, or any individual investor. They will put the loan on the property. There are some that are available that have no loan on them. They will put a loan, whether it's a 30% loan, a 50% loan, depending on the environment. Today, the loans are about 50%, maybe a little bit more at most. And the reason is because of the increased interest rates. And you want to make it a good investment. You want to make the numbers work out so you get a decent income out of it. So ultimately, they will put that together. One of the nice things about the fact that they already put it together, at least with the ones that I work with, is that you don't have the risk of a failed 1031. What is a failed 1031? Normally, what happens is there are very strict guidelines. Once you close on your property that you dispensed with, that you sold, the 1031 rules say you have 45 days in which you can then identify a property that will be your replacement property. And there are various rules involved as to how you do that, but you got 45 days. Going around looking for an investment property and identifying it in 45 days, those 45 days go really fast. Mm-hmm. And most failed 1031s occur because you failed to identify a property that you actually execute and close on it. And that's where most, and in which case, what is, when a 1031 fails in that manner, what does that mean? It means you owe the tax. You owe the tax. So again, the rules say you have to identify property within 45s and actually close on its purchase within 180 days of the closing of the property which you dispensed with. And that creates a challenge. Now, with the DST, once I know you, I've qualified you, I know your balance sheet, I know that it's an appropriate investment for you, we already have something that's already closed. Whether you go into this investment or not, it's done. You're not going to fail because you haven't identified or closed. It's like listings, they come and go. We see what's available, we look at them, we do our due diligence, we look at the real estate. Is it something that you want to own? We look at the financial structure. Is it reasonable? Are they paying you your cash return, your rents, your monthly rents? Are they paying you out of rents that they earn, or are they playing with it by basically picking up some reserves or paying you out of some other sources, which makes initially, at least the first year or second year, which makes the returns look a little bit better than what they actually are? That's where all of the financial due diligence, the financial structure comes in. It has to be looked at. But again, the nice thing about it is this, is that you can close in 3 days. Once you have been qualified, you identify a property, we basically say, let's do this. Ultimately, the qualified intermediary is contacted. Here is the investment property. They transfer the funds, and you're accumulating rent, usually within 3 or 4 days. Once you identify and you say, yes, I want to do this.
How long so if I'm understanding correctly, they buy the property and then they open it up as a DST. How long do they keep it open? Like, is there a rule like you have to only keep it open for 45 days, for 180 days, or a year, or just until they basically fill up?
Until it fills up.
So it could be a year, 2 years, or 3 years until it fills up. Generally, it doesn't work that way. I'm imagining
normally,
it very quickly.
It works. You have 30 days, 45 days.
At the most.
60 days. No, it depends. Let's say it's $100 million deal. Like, for instance, looking at one right now that I'm doing for a person, it's about 112 million of equity. And that's going to take them, probably in my opinion, it's going to take them 3-4 months. It's a very special building in Philadelphia. They're not, it's a very nice deal, but it's a large deal. So it's going to take them a lot longer to raise 100 million than it would raise if it was something that raised $20 million in equity. That might go very quickly. So it really depends. It's just like when you list a property, when it sells, it sells. No longer available. So it works the same way.
So let's talk about the financial due diligence. So we talked about okay, step one is selecting the sponsor and making sure that they are a large sponsor. When doing your due diligence on the sponsor, is there a where I know obviously you help out your clients with that. Where do you look, and what type of questions should your clients be asking you about the sponsor?
Okay.
Is it just that they're large? Is it does it matter if they've had any defaults? What payout rates are?
Well, it really matters that you understand who the sponsor is. So yes, you have to do separate than the property. You have to do you have to know that sponsor. You have to do your due diligence on that sponsor. And yes, you do look at their legal record. You look at their capitalization. You look at, for me, it's really important to look at their behavior with investors during troubled times. Everybody's been doing great with real estate. If you look at the last 10, 12 years, minus perhaps the last couple of years, the wind's been at everybody's back. So a lot of people perform well when the wind's at your back, but you want to see how they perform, number one, generally, and number two, how they treat their investors in times of trouble. So if they've been around in 2008 during the great financial crisis, then it's a really good indicator to see if ultimately maybe they subjugate some of their management fees, so that the investors can be made a little more whole. Those are all real positive indications, because what happened to many of these people, many of these sponsors in a period like 2008, 2009, is they disappeared. And they couldn't leave their investors holding the bag. So I think it's extraordinarily important to understand the sponsors, to see that they're well capitalized, and to see what their philosophy is by looking at what they do, how they treat their investment in times of trouble. Do they want to be around for a long time, or when the going gets rough, are they going to fold and go into another business? So that's very, very important. So you do the due diligence on the sponsor. And there is, from my perspective, the way that I do it, I do due diligence, but also my broker dealer does quite a bit of due diligence. And there's a department that looks at these alternative investments, and they do diligence on the sponsor. They do the due diligence on every single deal, every single real estate deal. And not only that, there's also there are third parties whose sole job is to do due diligence on these particular projects. And all of the ones that I use that are sponsors of these DSTs must allow for third-party due diligence to be performed. So there's also a third-party due diligence. There is a report where they basically check that everything of what these guys are saying is true. They do everything from also double check. Did they do a phase one? Did they do a phase two? Did they do everything? And if they look at the rent rolls, are the rent rolls really there? So you have to actually be able to look at those documents. So there are several, and I don't usually look at all the individual documents and all the individual leases. As a matter of form, I look at them, but these guys actually examine them. They will go and interview. So there's various layers, and it's not just me. And it's important to me because no matter how smart I may be, it's really important to have different sets of eyes with different sense of expertise when you're doing your due diligence.
Is it expensive to hire one of these companies, or what can somebody expect
Yes,
to charge?
it is. It is expensive to hire them, and they must pay that fee. That's why we're saying they have to participate in this. We don't have Because there's some out there that won't. They won't allow for a third party due diligence to go in there and dig. And if they don't, then
Red
they're
flag.
not under consideration. Because part of it, and once they do that, it's available to everyone. So, but it has to be part of the process where there are certain parties known that do these third-party due diligence reports, and they must be they must subject themselves to be able to have these companies go in and dig in and produce those reports.
Where have you seen the biggest mistakes when people do Delaware statutory trust?
The biggest mistakes that I've seen, clients make is when we look at the possibilities that are available for them, and they go for the one that gives you the best cash-on-cash return from year one. They're allowed to project up to the first year, and they have projection. They have pro formas beyond that as well. And they go for the ones that, if there's one that is going to give you 5% and the other one's going to give you 4.5%, they'll choose the 5%. That's not always a good idea, because what you ultimately want to do is you want a better absolute return. And sometimes there's a lot more risk in the one that gives you the 5% that isn't worth that extra 0.5% of return initially. So, and these companies that put them together, they know this. That's why a lot of times they will financially engineer, if you will, a greater, return that they can show in the beginning, because that's what they know that relatively unsophisticated investors, that's what will lead them to choose one versus another. And I'm there to guide them and let them know why this might be better or that might be better. The ultimate choice is theirs, but it's really important to look at more than just that.
Yeah. Would you say that the important decisions when considering a DST is, one, who is your investment advisor, and then two, who is the sponsor, and then three, what asset class? And do you have certain asset classes that you would stay away from right now versus others, and why?
Okay. Again, really good question. First of all, you need a financial advisor that understands real estate.
Why?
Because you're buying real estate. You need to learn how to underwrite real estate. So investment advisors, many of them, they'll deal with stocks and bonds and all that. And then all of a sudden they have available through their whoever it is, the large firm that they work for, they have one or two available. So everybody will go to that one or two, and they will get it to their department that specializes in it. But the investment advisor does not. You need an investment advisor that deals in this stuff, that knows real estate and knows securities, knows DSTs. And because it's part of your whole, the DST in real estate is part of your whole. It's not just a single thing. It's part of the whole. So you need someone who understands and who gives you the different options, and in the context of what is in your best interests. So that's number one. The sponsor, again, like I said, very, very important to have the proper sponsor, since they're the ones that have the control of management and also when to sell. And number three, you're talking about asset classes, and that's a very important thing to look at when you're dealing in real estate, because at different times, different types of real estate assets may perform differently. And the alternative, for instance, that yesterday I was talking about a deal with a commercial real estate broker, and they were dealing with an older client who's like 80 and doesn't really want to deal with being a landlord. Mm-hmm. So their go-to is to do what's called a triple net. They were looking at I won't go into details, but at a restaurant, basically. Yeah. It's something, it's a restaurant, it's already
KFC
rented.
Building or some sort of,
that's rented out. And so they were looking at that. And so it's a triple net. Triple net basically means that the tenant is going to pay the property taxes, They're going to pay all the maintenance costs and so forth. So basically, it's a check that you get, and hopefully you get it every month and everything goes well.
Mm-hmm.
The issues that you look at when you see this lease, when you're dealing with a triple net, is they have long-term leases. And this particular one had 11 years left on the lease, which is pretty good. And there were increases every 5 years on that lease. And they were basically getting 5% every 5 years.
Mm-hmm.
So what happens? We are today in a much more inflationary environment than we were 5 years ago. So if you're going to get a steady coupon, steady rent, and even if it's a paycheck and you don't have to worry about maintenance and all that, which is a good thing if you don't want to be a landlord, you're going to basically get your rents in nominal dollars, and it's not going to go up very much. And if inflation isn't very much, then you're okay over the next 10 years. But when inflation starts to creep up, the value of both the real estate and the value of the income that you make goes down. So triple nets are a problem today. They're not the best asset class for that reason. There are exceptions to that, and any given investment could be different. The other issue with it is that if you want to sell that property, let's say in 10 years, you sell that property in 10 years, you got 1 year left on that lease. Any buyer isn't going to pay you full price for 1 year left on a lease, or 2 years left on a lease, or 3 years left on a lease, because there's always a danger they won't renew. So if you sell it, you're going to have to sell it at some form of a discount. So it very, very much depends on asset class. Now, in an inflationary environment, a multifamily, for instance, rental property, Class A rental property, you have 1 year leases. Let's say you have 300 units, and you have 1 year leases that constantly come up. And if there's inflation, what does inflation mean? It means prices are going up. It means rents are going up. It means you're increasing your rent at least as much as inflation or more. So you're keeping up with inflation. The value of your property continues to go up in nominal dollars, and you're much more protected in an inflationary environment, not to mention demographics. You're much more protected. So multifamily is one of the things that I think is better in an inflationary environment because of the short-term leases, and you can continually turn it over and increase rents. There are others. For instance, just from a supply and demand point of view, industrial real estate has done well. These are like the big logistics centers for Amazon, and smaller logistics centers for Amazon and other companies, FedEx, others. Why? Because today more and more people are buying online, and rather than going to a store, they order it online, and the logistics of going ahead and getting that to you, getting it to your door, involves large logistics centers outside of the city, smaller warehouses inside the city from where they ultimately ship out. So these warehouses are very, very sophisticated, and they are increasingly in demand. So from a supply, demand, and just the growth of the need of demand for these places, they've done well, and they're probably going to do well in the long run. And a preferred asset class, in my opinion. This is basically my opinion. And there are other asset classes that are really have been done well. They go up and down, but self-storage is a very good asset class as well. Student housing is a good asset class only in the major universities. It's very important to keep them in the major universities that attract talent always, including in times of economic trouble. When the economy goes down, sometimes enrollment in the outside universities or colleges is not as good, but there's always very strong demand at the tier 1 universities. So there are a lot of exceptions, and of course there's others. There's, I think, for outpatient medical services, just for demographic reasons, baby boomers refuse to die. They're going to be around forever, and they need to go to the doctor more and more as they get older. And so somebody's got to rent these doctors their offices, and for all the outpatient centers where they might do outpatient surgery, they might do your MRI or your CT scan. All of these things are in very high demand. And just from for demographic reasons, as our aging populations will need to use more and more of those services, whereas the reimbursement for those services go up and down with the financial balance sheets of the insurance companies. You're the landlord. They're going to pay you rent. They're going to pay you rent. So it's very important to get into the proper asset classes.
Yeah. What are the negatives of a DST relative to like a triple net lease?
Okay. A triple net lease, you are still the landlord. You are still responsible for that piece of property. One of the advantages you have in doing that is if you want to sell. Say, I want to sell. If you're going to do triple net, sometimes it's a good idea to sell every 5-6 years and do another 1031. Why? Because as the period of the lease shortens, you don't want to get to a point where you want to sell when you have a very limited time left on that lease. So you might want to exchange. Every transaction that you do has cost to it, but it might be a good idea for you to do. And it may not be what you want to do as you get older, but you can sell if you want to. A DST is an illiquid investment. You put your money in and you don't know when it's going to sell. It sells when the sponsor says it's a good time to sell. It's great for my investors now to sell it. So you don't have control of when to sell it. Having said that, you do have some indication of how long it can continue. Let me give you an example. One way you can tell is when you're dealing with commercial real estate and you're buying a property in the DST, you look at the financing and you look at the financing period. The financing period, depending upon the asset class, might be 5 or 7 years. And they might even have an interest-only loan. However, once that loan is due, it's due. You have a balloon payment and you have to refinance. The structure of a DST cannot refinance. That's one of the things in the revenue ruling of the IRS. You have no capital calls. They can't ask you for more money if you need repairs as the investor, and there's no refinancing available within that structure. So they are going to sell it prior to the end of the financing term. So if there's a 7-year loan on the property, and you can see the terms of the loan, you know they're going to sell it 7 years or less. On multifamily, a lot of times, Fannie Mae, they might be 10-year loans. So you know that they're going to sell it that particular time. So there are indications that they'll tell you, but you don't know when within that period they're going to sell. And that, to me, is the main advantage if you want to maintain control of when you might want to sell it. A DST should be treated. A lot of people say you can sell it on the secondary markets, but if you think that you might want to sell something as an investment advisor, selling it on the secondary market, you'd be selling it at a big discount. And the whole idea of investing isn't to go ahead and pay one price and then sell it at a lower price. So you must have, this is one of the things that I check, you must have enough liquidity that you don't need to sell this investment in order to live. So you don't have control. You don't have control, that's number one. Number two, they cannot refinance. And you cannot have any big capital improvements because you can't raise funds. You can't raise any more funds once the money's been raised. You can't raise any more funds. What does that mean? It means that also, in addition to particular asset classes, I also don't think it's a good idea to invest in projects where there's a lot of value add component, where there's a lot of uncertainty perhaps on any deferred capital maintenance. So you want to buy, as a general rule, there are exceptions to that, relatively new property. There's predictability as to what your capital expenses or maintenance expenses are going to be, and that are relatively stabilized. So you want to already buy property that is well stabilized, that has rents coming in, that is, if it's a multifamily, let's say, that is 90+% occupied already, and is bringing you, actually what the cash flow is on it. So you want stabilized properties. You don't want, it's for people, the clients don't want to make a killing. They don't want to go ahead and take huge risks and try to develop something. They want stabilized property. In all fairness, my expectations that I try to manage in my clients is what you want here is you want income. You want income to support your life. Ultimately, having a lot of money, if you can't use it, doesn't do you much good.
Yeah.
And if you don't spend it, your kids will. So ultimately, you're making income and you are preserving the value of that asset. If markets do well, that asset will go up. If markets don't do well, it's real estate. It can go down in value as well, which is why also you don't want very high leverage in today's market where interest rates are relatively higher than they had been in the previous 10 years.
What's the highest loan to value ratio that you can exchange into? Like, so if somebody has like 80% debt comparison to 20% equity, are there DSTs that would support that?
Yes, there are. There are DSTs that come out every once in a while, a lot less frequently now than we had when interest rates were lower. We have DSTs that come out with 80%, 85% loan to value. We usually call them zero coupon because they won't give you a distribution. They will pay down principal in essence, but they won't give you a distribution. And the way that I use those, because most people don't have that kind of leverage, they'll have,
30%.
Used to be, 30%, or used to be even 60, 65%. So something you could do with a DST that you might not be able to do if you buy property is I can put the right combination is to replace the loan and to replace the total equity that you have in there. So I would put some money in something with a 50% loan to value that pays you a good income, and I would then I would put you in a little bit of the 85%, such that we cover your debt boot. The combination covers both your debt as well as equity.
Got it.
So the combination would be, we're allowed to put all kinds of combinations together. And the way that 1031 works, if you can buy multiple investment properties, and as long as the combination is such that you're replacing the full value of the property that you sold, as well as all the equity, then you can defer all your tax. So we can put combination.
What type of return can an investor expect to receive in terms of income? Like 5%, 6%, 7%, and then how often is it paid out? Is it paid out quarterly, monthly?
Most of the time it's paid out monthly. There are some that pay quarterly. And the amount of return you get, it depends on the deal. It depends on the asset class. But as a general rule, the multifamilies today will pay you between 4 and 5%. On the industrial side, a little bit more, maybe 0.5% more. And that is for the conservative, stabilized portfolios. And that's about what you can expect to get. The other thing that's nice about DSTs is you get a 1099-like report at the end of the year, and it shows basically what your share of the rents were, what your net operating income, your share of the net operating income is. You give that to your accountant, and he or she will continue to file your scheduling. And if you still had depreciation left, they will continue. You will still get the value of the depreciation. You'll still get very tax efficient income in that regard.
Got it. So let's say the loan comes up and the loan is a 10-year loan. And at that point, they can't refinance, so they can't extend it.
No, they can't refinance.
And let's say that they don't have equity at that point. What happens in those scenarios? They just sell at a discount? And is that common at all, or is that like a rare event?
I've never seen it happen. No, it's rare because they're not going to sell. They're not going to wait, to sell it in 10 years when the loan is due. The cycle, the real estate cycle, is such that they will, maximize the value of a sale at a particular, and they have 10 years to do it. I've seen DSTs put together. Ultimately, they sell after 2 or 3 years, just because they got a really good price, and they return quite a bit to the investors, who then can do another 1031 if they wish to do so. So I've seen them go in 2-3 years when the markets are hot, and but ultimately they have to find a period within 10 years where it's the maximal best time to sell. So it would be very unwise for any of them to wait, for 6 months before the balloon payment is due and put it on the market at that time. Conceivably, it could happen. Theoretically, I haven't seen it happen.
Most of them get fixed financing, it sounds like.
Yeah. Oh God, yeah. It's most of them will get fixed financing, and again, for a much shorter period of time. It's not like buying a home where you have a 30-year amortization schedule.
What else would you say would be important about DSTs?
Well, the most important really is it has to be the proper client. It's not for everybody. It's not for a young man such as yourself who understands real estate and who goes and finds really good deals on the market, and you can really do some value add, either manage it better, increase the NOI, increase the net operating income, and then ultimately increase the value of the property and sell it for a huge return. It's for people who don't want to mess with it anymore. So generally what I find is it's ideal for people who've owned real estate for a long period of time, as all Americans who want to preserve the cash in their pockets rather than pay it out in tax. So they want to defer the tax, but they certainly do not want to exchange one headache for another headache. So it's mostly people that are older, that have owned real estate for 25 plus years, and specifically don't want to deal with the real estate anymore. That's the number one type of client. Now, additionally to that, it is a wonderful tool for people such as yourself that, let's say you're doing a 1031 with someone and you have some boot left. Let's say you've sold a $2 million property and you found another great bargain for them, and you paid, $1.7 million for it. You still got $300,000 of boot. Or let's say you've got $327,056. I can place exactly that amount, 326 and whatever it is that I said. We can basically say we can put exactly that amount so that you don't have to pay the boot. So it can be used also in order to scale the 1031 exchange such that you can defer the taxes with the exact amount of money that you had. It's sometimes difficult to get the exact amount of money invested. Usually you either have to put some more money in, or you're going to end up with some tax boot. So it's a wonderful tool to use for that purpose as well. And specifically in California right now, I've been dealing with a residential real estate office by teaching the agents about 1031 exchanges, and the commercial real estate brokers know 1031 exchanges really well. A lot of I found, and correct me if I'm wrong, that a lot of the residential real estate people do not know a lot about 1031s.
No.
So this is as an opportunity to be able to get more listings. I went in with a presentation with a suggestion that you go to your favorite title company, you get a list in particular zip codes that you like to farm, and you go and you do a search criteria where you have basically owners that have owned properties for 25 plus years and that don't live in the property. So basically it's investment property. basically go out and distribute, whether in many ways to distribute through mailers or whatever, that they do have an opportunity, especially in California, where being a landlord has become more and more of a burden.
Litigious as well too.
Exactly. So they might want to get rid of their property while knowing that they don't actually have to manage another piece of property. They can still get the tax deferral, and they can, in essence, do something where they don't have any more management responsibilities. They still get their rents. They defer all their taxes, and they have a much more convenient estate planning tool in terms of their own future.
It's interesting because a lot of agents that aren't familiar with the DSTs, what they'll hear from clients is they'll hear things like, I'm tired of managing the rental property, but I don't want to pay the taxes. And
this is a real solution that they don't know about. And if you're a residential real estate agent and you can become the expert on this,
it gives you a competitive edge.
You're going to have a lot of business. It's like in different environments, it's great to do the normal stuff. You farm your area, you get to know the people and so forth. But in different environments, let's say if you can become the expert on selling probate properties, doesn't mean you can't do the other stuff, but you are the go-to guy for doing probate. In times of the great financial crisis, if you can ultimately, get a relationship with the banks and do the REOs, then you are the expert on that. So having a niche that'll differentiate you is powerful. Yeah. And this environment lends to it, and most people don't know about it yet. So I think it's an opportunity. I've only made one of those presentations to an office, and they put out a postcard, and I'm telling you, it's been a nice experience. It's been nice.
Well, I'll tell you this: like I've had clients that come to me and they're like, "Look, I've already spoken with 3 agents. They say that there's no solution for me. I'm tired of managing the rental property. I don't want to pay the taxes. What are my solutions?" And as soon as I say, "Have you ever heard of a DST or a Delaware statutory trust?" They're like, "A what?"
Yeah.
I explained it to them, and they're like, "Oh, like I wasn't aware of that. Can you send me some information on it?" And it's basically the perfect solution for somebody, like you said, that is tired of being a landlord, doesn't want to pay the taxes, wants to step up in basis, and still wants the income and still wants to keep the depreciation, the tax benefits that you receive. So it's basically a solution for somebody like that. And now, not only that, but another pattern that I notice is that as people get older, they want to get rid of debt. So like if you have a $500,000 loan, you don't want to be responsible for it. So in this case, you let the sponsor be the responsible party. Right. So let's say that somebody enjoyed this interview and maybe wants to connect with you and get more information about Delaware Statutory Trust. How would they get in touch with you?
Best way, Life Strategies Advisors, put it out in Google, and hopefully I come up. And, I'm a teacher. I teach, and I make sure my job is to make sure that if DST is right for you, that you are both qualified and that it is in your interest to go into something like this. And if it isn't, I won't do it. So,
well, not only that, but I could tell by the way that you break down things that you're very methodical as it relates to your thought process, like step 1, step 2, step 3. At least that's what I could tell.
Yeah, I'm a real problem solver and a real advocate for my clients. You know this, but my background is I'm a doctor, and I'm a really good problem solver, and I'm a really good advocate. Same here. I also am a real estate investor. I've been a landlord for many, many decades. And I am also in the process of the same thing. I don't want to be a landlord anymore. So I've been selling properties, and I put myself into the proper DST as well. So I'm a baby boomer who's doing the same thing because my happiest clients were doing this. Once they discover this for the right person, when they discover this, they're very happy.
Oh
It
yeah.
really makes their life a lot easier, and it relieves them of a great burden on their shoulders.
Yeah.
Again, for the right person.
Especially in California.
And in California, there are more right people than there otherwise would be, because it's become quite burdensome to be a landlord in California. Everything's going for the tenant, and it's very difficult to be a landlord, and getting
Yeah.
more so.
So I want to say thank you for taking the time to be on the podcast today. For our viewers out there, we talked about DSTs, Delaware Statutory Trust. We talked about who are they, what are they, who's the ideal avatar or ideal client for them. We talked about the pros. We talked about the cons. We talked about how to underwrite them. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that share button. Thank you again, Dr. Rubin, and to our viewers, until next time.